Next time we have a top, so there's your low, there's your high, there's your low, there's your higher high, and here is your higher low potential. Because what are you saying then? You're saying, I expect the price will continue to respect the moving average that it respected before, i.e. the 4-hour bands staying green. And if it continues to do what it has been doing before, then I will continue to trade in that direction. If price stops respecting that trend, meaning the bands go red or the bands don't produce a new high, so that looks one of two ways. Price goes to a new low, right? It hit the bands, it went to a lower high, and it made a new low. Or, I should say, the bands go red, then something has changed. Previously, the bands would not go red. This time the bands do go red. Okay, it's not respecting the primary trend. Previously, the band retest produced a new high. This time, the band retest does not produce a new high, which would be a market structure break. Therefore, I exit. Exit the trade or start to look at trades in the opposite direction. That's how you should approach this with whatever time frame, indicator confluence that you're using. Market structure, combined with whatever confluence you use, is all about one simple question. Is price still respecting the principles of whatever the system is? You design and develop the system, and then you say, okay, when price stops respecting the thing that it was respecting before, I expect a different outcome. I expect something different to happen. You can see this as well with, it happens all the time, over and over and over again. But something like SUI here. So for this entire uptrend, SUI respected the daily bands, meaning it comes into the daily bands, and even though the internal structure here is messy, right? If you're just looking at these candles, you might think this is a weakening trend, but remember, the trend was here, this is the consolidation. So the bands hold, it makes a new high. The bands hold, it makes a new high. The bands hold, but it doesn't make a new high. And again, the point at which you have confirmation of that is when it makes a break of structure here. Right, so get all this shit off. At this point, after this candle, you can say, okay, last time it hit the bands, it went to a new high. The time before that, when it hit the bands, it went to a new high. This time, it hit the bands, it consolidated, then it had a break of structure, BOS, and it did not make a new high. That's your first warning sign. And what happens? It goes lower again. So now it doesn't respect the bands at all, and now you have a market structure break. Right? You have this previous swing low that led to the highest high, breaking. Now you can say, and notice all of this, if you're just following the bands and you're not considering market structure, and you're not considering is price behaving the way it was behaving before, you could still say that SUI has not broken its trend because the bands are actually still green. But it's quite clear that you would want to be out of any long trades. If you're in a long from here or here or here, you'd want to be out of this long trade there. Instead of still sitting in it, hoping maybe it's going to reverse. Well, no, it's no longer respecting what it was before, which is the bands do not produce new highs. So then you're starting to look for, okay, what's going to happen next? Maybe it's a reversal, maybe it's not. Maybe it's just going to go into a lengthy consolidation. It doesn't tell you that there's going to be a reversal, but the reversals are the next thing I'm going to talk about. So reversals, probably one of the most important things you will learn, and a very, very important application of market structure. So it goes along with the exact same thing I described before. You have to find what price has been doing and been respecting. So in this example of last bull run, price respected the 50 EMA the entire way. So it held it back in January, and it held. It doesn't have to test it. It's holding above it, and it's making new highs. That's what respecting the moving average means. If it tests it, you expect it to hold. If it front runs it by a little bit, and it still makes a new high, it's still doing what you want it to do. Because what's it supposed to do? Test it, new highs. And then higher highs and higher lows. Doesn't have to touch it perfectly. Again, this is where markets are not perfect. But it does keep making new highs. It is all above the 50 EMA. So that's respecting. Then it stops doing that. And where it stops doing that is over here. At this point, the 50 EMA is not being respected. Price fails to make new highs off the EMA. Price breaks market structure, both here, which is like your fast reversal, sort of your interim low, or you could call that a swing low. Regardless, it's the low that led to the high. And then the swing low before that breaks that as well. So you have one break here, and price is below the 50 EMA, that is when price is no longer respecting what it did before. Therefore, you would expect price should go down into a reversal, into a downtrend. Now, the way you actually trade that is entering here is generally going to be directionally correct. But as a trader looking for entries, it's probably not going to give you the best entry with the clearest invalidation. Because almost always, what's going to happen is the reversal itself is going to first be preceded. The first thing that's going to happen is it's going to try and reclaim what it did before. So what that means very simply is it's going to retest the MSB and it's actually going to get back above the thing it previously respected. If you do this, and this is very simple, just do scenario analysis. Just go through the charts and look at whatever it is you're trying to test. Go and look at how price tends to behave in these areas. When it loses the thing that it had been respecting, whether that's market structure or whether it's moving averages, before it actually continues in its downward direction, it will try to reclaim it more often than not. So the best time, again, totally fine if you want to use this as your reason maybe to exit. So this would be a reason to exit a position. Because if you're looking to exit longs, you don't necessarily want to wait around for price to come back up to get this perfect exit. Because what that leads people into is what catches people out at the top of bull markets. You know, it's like, okay, I'll exit on the next bounce. And then the next bounce doesn't come up as much as you want. Well, I'll exit on the next one. And the next bounce, and then there's no bounce. That can happen. And that's what happened at the end of the bull market, right? So just a side note, this is where it's important to differentiate between, am I exiting a previously open position or am I looking to open a new position? It's two totally different things. If you're looking to short, this green box is a bad place to do it. If you're looking to exit your spot cycle bags, that is a good place to do it. Even though price comes up after, you don't know if it's going to do that or if it's just going to go all the way down. One of them is about protecting, realizing gains, protecting your capital, exiting your position in profit, or even cutting it at a loss. Maybe you entered here, right? The other is about trying to time a trade in the opposite direction. If you're trying to time a trade in the opposite direction, you're trying to catch the short down for a reversal, or you're trying to catch the long of a reversal at the lows, you should wait and wait for a better setup because you're able to better define your risk. And that's essentially, if you've seen the other lessons, the under-over double confirmation, that's what double confirmation is. You get your structure break, that's your first confirmation. Then you get your failure to reclaim, that's your second confirmation, right? First time it breaks structure, that is a trend shift. The second time it tries to reclaim that structure and then loses it, that's your double confirmation. That gives you extra confidence that the trade is actually going in your direction. And that's where you'd start to directionally trade it in the opposite way. And that will get you in at the earliest point. Not the earliest point where people think, oh, the earliest point is you have to short the top. Yeah, if you're a moron. The earliest point where you have a confirmed trend shift. There's no confirmed trend shift here. There's no confirmed trend shift here or here. And it doesn't mean you can't exit for other reasons. But if you're basing it purely off of market structure, and you're trying to identify what is the primary trend and how do I trade it, you want to wait for something like this. So wait for the failed reclaim, get in there. Over here, looking at the exact same thing, just on a lower time frame. Price on the way up here in this trend is respecting the 50 EMA. So why was price staying above the 50 EMA all the way? Just think about it. There was a bullish market for whatever time period we had, for however long. There was a bullish market. We know that because price made higher highs and higher lows. No matter how messy it looked, it kept going higher, and each low was higher than the previous higher low, and it respected the 50 EMA. Every time it came to the 50, it held. It held. It might have dipped below for a little bit, but it kept holding and holding and holding. It did not go below it and stay below it. And then each time it hit the 50, it made a new high. Then it loses the 50. It does not make a new high. It then has a market structure break below this swing low. And then price is spending time consolidating below the 50. This is your high probability confirmation of reversal, but a low probability entry for shorts. So again, exact same thing I said before. This red box would be a reason to exit longs if you're long from lower. Absolutely. Because whenever it started to break down further, it could have just kept breaking down and retraced the whole thing. You've seen this a bunch of times, right? The market can unwind very fast. And you can be sitting saying, oh, I got my confirmation here, but I didn't close my long, and now you've round tripped it. Well, you should be exiting. If you're trying to short it, you have to be aware that people will start shorting here, and they will short more and short more and short more, and that adds fuel for the retest. So you squeeze up, you get a retest. What does the retest look like? It tests the MSB, so the black line. So it did not test it here. It lost the 50 and it broke structure, but it did not have a retest. It then comes up, it has a retest. The 50 EMA is not being respected. Not anymore. It's spending more time below it than it is above it. It was previously spending all the time above it. This is the market telling you something different's happening. Whatever was making us go up from the 11th of October to the 20th of October for 9 days is gone. Because the people, and markets are all people, right? And some fucking robots. But the robots are coded by people. Markets are by people. The people were buying every touch of the 50. The people were not allowing the market to make new lows. The people were forcing the market into new highs. Those same people are not doing that anymore. Behavior. That's what I mean by price behavior. Price is behaving differently, and price does not move by magic. Price moves by people. Buying and selling aggression. So, the opposite is now happening. It's spending time below the 50. The opposite is happening. It's not making higher lows, it's making lower lows. And then when it comes to the retest, where would you actually enter this? Green box. You might think, oh, I should short here, I should short there. There are other methods you can use, specifically like the over-under that I've mentioned many times, right? Where price comes up, left shoulder, head, right shoulder, and you could just enter on that retest with your stop loss above the high. So you would have entered somewhere around here with a stop there. Great. Absolutely. Go test it. That's classic market structure. That's like the first lessons on it. However, if you're looking at where is the highest probability of a trend shift, confirmation happens here, double confirmation happens here. Why? Because it has your first confirmation tells you that this market is now reversing. It then tries to undo that. It gets back above the 50. It tests the market structure. It even closes above the market structure level. And then it loses it. So as soon as that candle closes and we're back down here, all of this now is price behaving, not like it was on the way up. And then you look below. And you clearly have areas where price can go and revisit. Such things as, for talking about targets, untested areas are targets. Because if price trends up and then stops trending, unless it's able to reverse that, and by the way, because this is live, this is not a prediction by any means, price can absolutely go up here, break out of that level, come back and hold, and then suddenly we're back into an uptrending market, right? Because then it invalidates the breakdown, it moves up, makes a new high, that's the key thing, makes a new high, and flips the market structure level, gets back above the 50 EMA, and boom, we're in an uptrend. Great. This absolutely can be a consolidation before new highs. But if it's not, this is exactly where it's going to go down from. It's tried the MSB. So there's no real reason why price would go back above that level unless it was just coming to, really fuck with people and sweep those highs and come back down again. That can happen. But you're talking about probabilities, not certainties. You have a single low below, which has been untested. You have many gaps in between. You've got order blocks. You've got a bunch of stuff on different time frames. You can take those and test them yourself. But this is your high probability entry area. This is your high probability area to close positions. This is your low probability area to enter shorts. You want to wait for the attempt first for a reclaim of the 50. Happens. Reclaim of the market structure break. Happens. Both fail because it goes back down below and it breaks the structure. It's now below the 50. It's broken that structure. You have a failed attempt to reclaim the 50 in the market structure break. And now you should view it as a downtrend until that gets invalidated. And this is the other thing. It's very easy to start thinking, oh, well, this has to be a reversal. Yeah, it could be. But everything has an invalidation. So your invalidation would be what? Like I just said. If it starts to reclaim the MSB, the thing that it couldn't reclaim, and it starts to reclaim the 50, the thing that it was supposed to be bearish behind, that's your sign that we're going the other way. And a failed bullish setup is a bearish setup. A failed bearish setup is a bullish setup. That's how they work. So that's the multi-factor nature of reversals. That's taking price and structure along with something like a moving average or a gap, an order block. You can use volume profile as well. Very good for this, and so on. Targets, So targets. Let's take a higher time frame view here. This is the big thing that everybody was looking at during the summer, right? The first thing, you want to look at your primary time frame, let's say on the daily at this point. Whatever has been happening, you expect it to continue happening. So we have a high, we have a low. We have a lower high, we have a lower low. We have a lower high, we have a lower low. You can see that quite clearly. Price keeps making new lows and it does not make highs. It does not break back above the previous highs. It then has an internal structure break. What does that mean? Well, it got above this high. Right, so this high, which was the lower high, went to a low, lower high, which led to a new low. It had an internal structure break. So at this point, it's completely valid and fine to say, I don't think I would want to short this or sell because there is a chance that this is a reversal. It's going to lead to a further breakout. However, at the red line, that gets invalidated. Why? Because the structure, the important level, the important structure level, which was the impulse, pre-impulse level, gets broken. And at that point, that's why I've drawn the red, at that point, this actually becomes a lower high. And the target of another lower high would be another lower low. And it goes to another lower low. That's why whenever this structure started to form, you'd be looking at a new low as your target. Then we make a new low. So it's now continuing its previous market structure trend. Lower highs and lower lows, expect that to continue. When we had that Trump rally during July, and price came up into this area, at this point, it's totally fine to say this is an uptrending market. Internally, it's trending up, it's making higher highs and higher lows. So you don't have to guess and say, oh, this is going to be another lower high. You don't have to do anything. When it breaks the swing low. When it breaks the second low, right? At this point, you're saying that is now a lower high. From everything that we've seen, there's no reason why this lower high would produce anything different to all the previous ones because it's coming off of a lower low. And so the target for this is not a retest of the lows. The target of this is not a double bottom. The target of this is not a higher low. The target of this is a new low. Because until the market changes its behavior, you expect the same thing to keep happening. So it goes to a new low. Then we get the first shift. Right? So then we get our actual internal shift, which is seen here. Price comes off the low. And what you're expecting then is, okay, if this is a lower high, then we go to new lows. Price doesn't do that. It goes up. You have an internal break. Okay, cool. So our target is up here. Price continues and then it breaks down. All right, this is a reversal. This can go to new lows. And so as it comes down, totally valid to expect new lows. Then we get into the price action we've seen recently, where you have your market structure break here, you have your internal levels here, and you're starting to see this forming as a higher low. And it breaks above this level, so now you've got more structures internally breaking to the upside, and obviously you see it all the way to where we are now, and here we are. So the keen eyes amongst you will know that actually, and this is why there's people, there's people on Twitter who are saying this is not yet a confirmed higher high. And they're absolutely correct. There is no trend shift yet. This could absolutely be a lower high. It can be a very slow moving one. It can have an internal upwards market structure. But actually, the high, which led to the lowest low, has not broke. And we have an internal break, just like we did there. Right? We've internal breaks and internal breaks, but it's no different. Structurally, no different to April. No different to May. So again, why is 70k so important? Why is this actual break of this level so important? Because this doesn't mean we go to the moon. This means that any pullback should absolutely form a higher low no matter what. There's absolutely no way it should go below there. And certainly no way it goes below there. If it does all of that. I don't think this is the most likely outcome, but it's absolutely possible from here, because it's been unable to break it. I think it's absolutely possible from here that it can make a new low. Again, not high probability, in my opinion, but from market structure perspective, it's doing exactly what it has been doing. And despite the fact that there's internal structure breaks, which everyone's talking about, like, again, I mean, I look on Twitter and I see people saying this. They're like, yeah, but its internal structure is going up. Internal structure is going up. And I was like, okay, so what does that mean? They're like, well, that means it's going to make a higher low and break out. I was like, well, so internal structure, internal structure, internal structure, internal structure, and it didn't do it. So, again, you have to look at what's been working before. Is it still working? Is price still respecting what it has been respecting before or not? That's all that matters. Now again, my money is on this breaking out. I think we can dip lower first, but my money is on it breaking out. But that's why when you hear people say 70k is the confirmation, it's for valid reason. That is where we would have our first actual market structure shift. Because the high that led to the lowest low would then be broken. We get that, boom, done. Any pullback, buy the dip, absolutely, away it goes. Next, last, right side of the V. This is a way to visualize the market, okay? You've heard me talk about this a bunch. And this is mostly about if you have a problem with entering too soon, it's almost certainly because of this. It's almost certainly because you're trying to get long when it's looking like this, right? Because you're seeing some of these bounces and maybe you see something like that and you're like, oh, it's reversing. This is a downtrend. This is a downtrend. Down, down, down. And if you imagine it as a V, you want to be entering on the right side. Terrible line. There you go. You want to be entering on the right side of the V. You do not want to wait till here. Your goal as a trader is to enter as early as possible in the right side, which simple market structure, right? The simplest way is the MSB. So no reason to buy into any of this. Does that? Well, that's a reason to buy because it's had a market structure break. You can buy here, and if it starts to move up, perfect. Okay? Now, in reality, how markets move is retests will happen. In reality, how it tends to move, it'll go down, it'll go down, it'll go down. It will break that structure, but it'll make a new low. It'll come up, it'll go sideways in some kind of a consolidation first, and then start to move up. Right? That's where you look at your Wyckoff accumulations, distributions. That's where you look at your box method, where it forms consolidation. This is more likely than this, but you should visualize it as a V. This is still a V. If you zoom it out and you imagine it like that, this is still a V shape. Your goal is to identify, are we on the left side, in which case the trend should continue. I should do nothing in terms of reversal. Or are we on the right side, in which case I can get long or short. And so visualizing this on the chart. This is an intraday trend reversal. The yellow line is the top of the V. And I'll take the V off because you can see it now. You have price trending up. Low, high, higher low, higher high, higher low, all the way up, up, up. Then you have a structure break here, right? You have where the red line is. That's your earliest identification of a trend shift. But that is a low probability entry. Again, back to what I said before. When you see this and you see it breaking there, that's when you can say, okay, this is quite likely to be starting to move into the right side of the V. And you have a market structure break and it makes new lows, new lows, new lows. Anywhere in that red box, and if you look at like the bands, for example, the bands go red, right? You can confluence tools. Any of those points there in the red box are completely valid for you to say, I want to exit positions. But they are most likely not the best place to enter new positions. If you find that you short at the first sign of reversal and you seem to get squeezed out like this, even if it doesn't make a new high, this is why. It's because you are getting the first sign of reversal, you're just not waiting for the double confirmation. Double confirmation can be, remember, double confirmation on a under-over would look like this, or an over-under would look like that, where you have the first break, but then you zoom in and you wait for the exact same pattern on a lower time frame on the retest. That's your double confirmation. Double confirmation, like I said before, would be waiting for your break to happen and then waiting for some kind of retest. And a way you can look at this is untested levels, especially on the upside. So we did pull back, it did reverse, it did start to break structure, but this level was left untested. How many times have you seen the market just top and go down and just never come back? Most of the time it will actually come up and sweep. It'll actually come up and take the highs because it will grab the stops of the people who short first. Or it can form a lower high, failure to return. Or it can form a double top or a triple top or a Wyckoff distribution. Any of those things are all signs of reversal. The only thing you need to do for trade entry is to wait for the double confirmation. What that would look like is the retest. You don't short here, right? But that is your retest. Cool. Now, high probability entry zone. Why? Because at this point, look at the chart. You are super, super, super likely to be on the right side of the V because it has come up, the 15-minute daily trend has ended, it has started to reverse, it's tried to go up again, and it's broken below that impulse candle. That high probability reversal. Entry point for shorts. Exit point for longs, entry point for shorts. They are not the same place. And I'll finish with this. And obviously, so target, by the way, target, mean reversion, untested low, right? Don't have to target new lows here. Target is, where is price not retested? There. You just view that as the full mean reversion, fill the gap, right? Order block, all that kind of stuff, right? And again, test all that. If you understand that markets do not go directly from a trend to a trend, that's why the V rarely happens itself. It looks usually much more like this, where it'll move up and it will double or maybe triple or sweep. It's the same thing, right? The end result's the same. It's just the application of it is different. And if you find that you are exiting one position and then entering another, you're probably doing it wrong. Your reason to exit a long, in this example, should not also mean that you have to enter a short. Because if you take that logic to its extreme, that means that you think the market always moves with perfect waves, right? That every time you should exit, you should also short, and every time you should close your shorts, you should go long, and every time you should close your longs, you should go short. That's not how it works, right? How many times you have to see it? It'll sweep. It'll take people out stops. It'll set a low. It'll go again. It'll come up. It'll double top, right? It's messy. And that's because people don't wait for the retest. So, high probability reason to exit your longs is a low probability reason to enter your shorts and vice versa. And then the high probability entry for the short tends to come after. You allow more price action to develop. You allow the impatient people who short here to get squeezed out. And of course, the same exact thing on the long side. So let me find an example here. If you were in a short and looking to get long, right, it's completely fine and completely valid to actually exit your shorts at a different point. Perfect example is here. Let's say you're short from up here for whatever reason. Price comes down and 1, 2, 3 pushes at the lows into a previous support level, reverses, closes here, holds. If you saw, and bands are green, I bet, right? Bands are crossing green. So at anywhere in here, at this point, if you were short from there and you're waiting for confirmation to exit and you saw the 3 attempts to go lower and it fails, it comes up, it breaks structure, it gets back above a previous high and it crosses the bands green, 100% absolutely completely fine and correct to exit your short there, to take profit on your short from higher. You'll also notice it is not the best long entry. So if you also went long there, you get stopped out. Why? For that exact reason. The market will come back down for the people who were mistaking short